Well, hi everyone, and welcome to today's webinar. It's the Intelligent Investor Growth Fund themed webinar, and it's the Finding Value in Founder-Led Small and Mid-Cap Stocks. And I'm Tom Wilson. I'm the investor educator at InvestSmart, and I'm luckily joined today by the portfolio manager, Nathan Bell, and the deputy head of research, but also the resources expert, Gaurav Sodhi. Hi guys, thanks for joining us.
Afternoon, Tom.
Morning,
Hello,
Tom.
everyone.
And sorry about the delay, but definitely ask questions as we go on the right-hand side there. You can ask as we go, and we'll try and cover off all of the content. And just remember, it's general advice only, no type of personal financial advice. And what we'll do is I'll let Nathan take over and walk through the slides. Go ahead, Nath.
Thank you, Tom. Not sure if that's a bad omen, Gaurav, that you think it's afternoon at 10 a.m. in the morning.
Oh man, you know what?
Glad to have you riding shotgun with me.
I flew in yesterday from Brizzy. I was at an AGM, and time has meant nothing to me since then. Since I've been back, don't know what's going on. Don't know what day it is, what time it is, but I'm here.
I'm glad to have you here because this morning the headline of the presentation really gives away what we're going to talk about today. But normally I'd probably go through, particularly for new people, just a bit of a light framework about our investing approach. But because you're here and you're going to take us through the detail of two of our biggest holdings, people will have a very good feel for our investment approach after they hear that detail. So I'm going to skip straight through that and I'm going to get straight to the performance of the fund. And then I'm going to dig into a couple of market trends which are slowly changing and really explains how, or I'm going to explain how we expect to benefit, and then go over when you go through the couple of stocks. That'll be the real live case studies of how we approach putting the portfolio together and why they're our biggest holdings, and they really underline, I guess, they're specific examples of the themes we're talking about today. So if you look at the since inception numbers, going back to 2015, we've done 2% outperformance over, almost coming up to our 10-year anniversary for the funds, even though the model portfolio that essentially launched this fund goes way back to 2001, but the outperformance is the same. And I'm very happy with 2%. If we do 2% forever, that's absolutely great. That's huge outperformance, and very few funds can sustain that for long periods. But for me personally, I'm always aiming for 3%. I think given our experience and the fact we don't manage billions of dollars, the 3% is what we should be aiming for. And we were doing well over that a couple of years ago. And sometimes, we've had a couple of mistakes in that period, but that's not the reason why we're not outperforming by 3% or more at the moment. The reason, in my view, is more to do with the current trends in the market. And if you've been following the market at all, then you'll know what people have been talking about for years now, and that is the dominance of the biggest stocks in the market, and that applies to the US and to Australia. I'm going to use a lot of statistics today for my charts from the US. That's just because there's more information available and the trends are more pronounced, but it equally applies to Australia. And at the moment, we're seeing this huge trend towards the biggest stocks in the market. So if you have a look in the US, the Magnificent Seven, which everybody has heard of, have been absolutely dominating the returns and basically earned all the returns over the last 2 or 3 years. And the other 493 stocks have earned next to nothing. So if you're a value investor like us, then you're probably thinking, okay, I should be looking at the other 493 stocks. And in Australia, it's been very much the same, where the top 20 stocks mostly, but also those very fast-growing, very popular high-growth stocks like the Pro Medicus's and realestate.coms have really been driving the market, and that's left a lot of other things behind. And I actually think at the moment, the valuations for those biggest stocks in the market in Australia are perhaps ushering in potentially the worst period of returns in my career. So you have to go back to 2006 when I joined Intelligent Investor, 2018, coincidentally, when I rejoined Intelligent Investor, and then 2021 are some of the worst periods to be buying those big, large, popular stocks, and returns have been lousy for a lot of those stocks. People are probably most familiar with the banks, which have been ordinary performers mostly for nearly 2 decades now, or in some cases over 2 decades. And we're in a similar period now, but there is something that makes this period really different, and that's actually what I'm excited about, because normally as an investor, you get quite frustrated in these periods because you're looking for a needle in the haystack that actually doesn't exist, and you've just got to be patient until something undoes the market. And sometimes it's something you can expect, like anyone who was following collateralized loan obligations in 2006 in America was well aware that maybe they didn't think the GFC would be quite so bad, but you knew something was coming. The COVID bear market, that was a surprise. And then in 22, interest rates went up and the market went down a little bit, but not for too long. So some of those things were expected, some weren't. But at the moment, the areas that we're in, across all our funds, is the same areas that we're always in, and that is mostly in the mid-cap sector. And that's really, I think, is the best sector in the market most of the time anyway, because the big stocks rarely get very cheap, and they're generally pretty slow growth or quite cyclical. So that's your banks and iron ore miners. And then you've got A-REITs, which don't really grow very quickly at the best of times. Whereas the mid caps, where you get these very well-established businesses, lots of founders still in charge and excited about their businesses. They're growing faster than the big caps. They've got great balance sheets. They've got operate in these niche markets. They dominate. They're buying back shares. They've got all high return on equity that's increasing. All the things we look for, and so that's a particular part of the market where the ETFs, which are really, I think, driving this crazy valuations of these big stocks, which I'm going to dig into in a minute, has left a lot of value in these other stocks and these smaller caps in particular. And I just remind people that this is an all cap fund, so we can't actually own many small caps, so we have to be very selective with them. But generally, the rump of our portfolio is in that mid cap sector, which is getting a bit overlooked at the moment. And so this is unusual because normally when the market's this expensive, there's just nothing to buy, and that's just not the case at the moment. There's a particular, story in the market at the moment where if you're large or got very high growth, you're getting all the attention. So people who have been listening to me bang on about Ordinate for the last 5 or 6 years, that basically tripled in the last 18 months because it was a small cap that started getting noticed, and because it was in the tech sector, which is really where a lot of the animal spirits are at the moment. That stock took off. So now that's a much smaller part of the portfolio because we got a huge valuation and we took advantage of that. And now it's left a whole bunch of other stocks, which in my view, if they were trading at the crazy prices that I'm going to show you in a minute for some other stocks, and the portfolio will probably be 20%, 25% higher instantly. But we don't need all our stocks to trade at crazy valuations to get that outperformance of 2% up to 3% where I like it. We were well over 3% a couple of years ago. And again, I think it's just the trends in the market that are holding back some of our mid and smaller cap stocks. And when they finally get running, which is they are starting to do now, hopefully that 2% gets to 3% pretty quickly. So I just skipped through that slide because that's basically what I all just talked about. But AI and the dominance of ETFs are really taking over the market at the moment. So I posed a couple of questions. The banks have been pretty awful investments over the last 20 years, and that's despite the biggest credit boom we've ever seen in Australian history. And yet at the moment, they're trading like AI stocks, which is just ridiculous. If you've seen the operating performance of the banks over the last couple of years and recently, they're very poor. In some points, the earnings are going backwards, and they're boosting the dividends, trying to encourage investors. But you can't keep increasing dividends while your earnings are falling. And it's never been more competitive in the banking sector. We're hearing basically all the banking chiefs, partly because of the increased competition from Macquarie, writing loans below their cost of capital. So they're not even making any money on these loans. So that's a place that we really want to ignore. But yet alone, look at the valuations of Australia's banks versus the banks around the rest of the world. It just makes absolutely no sense to me. And so that's why we've got this 2% outperformance, which is great. But that index is being held up by this sort of behavior, which isn't going to last. Here's another one. So here's the question I pose is, how does AI improve your plumbing? And the reason is I've got Reece in there, which is trading at 40 times earnings now. Now, Reece is one of the most predictable businesses on the market and typically grows at single-digit rates. And yet the market's got all excited about the US expansion, which the CEO and the management of the company have actually been talking down, saying it's going to take a very long time to get the growth out of that business. It's a very long-term project, and I fully expect it'll work out great over time. But the market's already factored in, everything going extremely well very quickly, and that's just not what the company is saying. So this is clearly unsustainable, and it's probably never been more obvious to me in a market where the value is the easiest to see and the most expensive stuff is easiest to see. But the one thing I know isn't going to change in the market is that the people are just going to stick with what they know. So they'll stick with CBA as long as it keeps paying the dividend. They'll stick with Reece because it's been a pretty decent performer over time, and they won't go into the value. And so that's really what you're paying us for, is to go and find the value, and eventually value always wins out. So I've got this quote here: history doesn't repeat itself, but it often rhymes. And this isn't the first time in history where the mid and small caps parts of the market have been turfed out in favour of the large caps. Probably the most famous one for anyone that's either read the history books who was around back then, but the Nifty 50 stocks of the early 70s. The current environment is nowhere near that extreme, but it was basically you could just buy any of the high growth large cap stocks like Coca-Cola and those sorts of businesses and IBM, and you would do great. And what happened was people bid those stocks up to 80, 100 times earnings, and then it collapsed the following year. And I think most people who would have bought that bucket of stocks, I think, lost about 75 or 80% of their money. And it took, I think it was 36 years before you actually got your money back. So as much as we think long-term, not thinking quite that long-term, particularly when there's these great businesses we're going to talk about today that you can buy at great prices, and they've got all the things that we look for in a great investment. Now, here's a couple of stats I just want to talk about because this isn't exactly how I expect things are going to go, but this, talking about history rhyming, I certainly expect this is the general trend. And we're actually starting to see the genesis of this already. So this is a stat from the States, and the top five stocks have a combined market cap currently that is 3.3 times the size of the entire Russell 2000 index. So that's a much broader and a smaller cap index. So just these 5 stocks, and believe me, they are incredible stocks, don't get me wrong. This is the Alphabets or Google and Microsoft, these incredible companies, and these are the best companies that have ever been created ever in history. So there is a reason for this, but we're just talking about how extreme this has become. And so that valuation discrepancy is more than 2 times the level that it was at the peak of the 99-2000 time period when the tech boom was at its highest. So we really are in rarefied air. But what's more interesting to me, and this is really the key point, if you take nothing away from today's presentation, just remember this: from 2000 to 2006, so post that the tech wreck, basically, the small cap value, so that's important, small cap value had annualized returns of 16% per annum, while the S&P 500 was closer to 1%. And longer duration equities, so this is your very high growth stocks that people are paying 50, 60, 70 times earnings for, or 100 times earnings in some cases, and this very much applies to Australia. Those longer duration equities generated negative annualized returns for those 6 years. So that's where I think we're in a very, very similar period in history, and that's why we set the portfolios up the way we have. So I just thought some people prefer pictures, and this is basically that in action. So this is a chart showing this, again, it's in the US. It's the mid cap and small caps against the big caps in the US. And you can see that valuation discrepancy hasn't been this bad. You have to go all the way back to 2000 or 2001. So that's 23 years ago to be in a situation this extreme. But this is the most important chart for me. And this is essentially the same chart, but it's really that little blip at the end of last year or the start of this year that I really want to focus on. And the reason it's important is because you can see that little blip there was when people started getting excited about mid and small caps again. And the reason they got excited about them was because everyone thought interest rates were going to go down. Everyone thought the next move from Jerome Powell in the US and potentially in Australia was that interest rates were going to go down. And that essentially was the all clear sign to start moving away from the largest, highest growth stocks on the market and finding more value in the mid and small cap sectors. And that's coincided with some fund managers opening mid cap stocks. So when you see fund managers really trying to put their conviction to the test with investors, they obviously really believe that the value is there, and Gaurav's examples are going to show you why we think it's there as well. But what happened was inflation came out a little bit hotter than expected, so proving a little bit stickier than hoped. And then the central bankers thought, oh, well, maybe we need to put interest rates up a little bit again. And then so that little bit of excitement that finally come after essentially 20 years of underperformance just disappeared instantly, and people went back to the Pro Medicus and the real estates and the banks and the REITs and all these familiar stocks. But I think we're just at the beginning of that, and at some point, people will move past these macroeconomic ideas, and they'll start focusing on the stocks and the value. And to us, it's just absolutely obvious where the value is. So it's just a matter of time, I think, to where we hopefully get that 2% up to 3% outperformance. And as Gaurav's going to do, he's going to look at a couple of examples in a moment. But just interesting, there's another way to play this. You could just buy the complete index. You could just buy the small cap index and hope to outperform, and that may work, but that's not our approach. If you look at the small cap index, it's one of the worst performing indexes around the world. It's just terrible, and this is why small cap fund managers do so well, because they have an approach which is about just avoiding the losers, which generally are specky resources stocks, and just sticking with the winners. And if they do that, they can generally outperform by 2 or 3%. But interestingly, if you have a look, particularly at the absolute returns, and particularly where you see fund managers that have a small cap fund and then have their large cap funds, the absolute returns of the large cap funds are actually better than the small cap funds, even though the small cap funds are collecting all these fees because they're doing even better than this really crappy index they're getting compared to. So for us, that means that we really have to pick the eyes out of that mid small cap sector. It doesn't mean buying everything. We still have to be very selective. And the good thing about the small cap sector is, particularly for us, because we can't own many, because we have very strict liquidity constraints, because our ETFs are governed by the ASX liquidity rules. It means when we find them, hopefully there aren't many of them anyway, but hopefully they're really well run, got the great balance sheets, and those small caps can become the mid caps and then maybe even the large caps of the future. And Gaurav's going to talk about one of those mid caps that I think can be one of those top 20 large caps soon enough. Still got the founder in charge, great balance sheet, huge return on equity, all the things we look for, and plenty of growth in front of them, unlike the banks, for example. Just one thing I just thought I'd mention is this isn't an income fund. This is our key growth fund. But the dividends in the top 20 stocks are actually starting to fall for a lot of the big miners, and the banks are actually starting to go backwards. Or, as I described earlier, as the dividends aren't keeping up with the earnings, or basically the other way around. The dividends are going up, but the earnings are falling, so that's clearly unsustainable. Whereas the dividends coming out of our stocks are actually increasing because the earnings are increasing. So even though I don't sit here and think dividends are going to be the biggest part of our returns, they're actually becoming more valuable over time, and they're growing. And I think in an environment of higher interest rates and higher inflation, that makes those dividends more valuable than ever. So with that, I'm going to hand it over to Gaurav. Can you see that all right, Gaurav?
Yeah, I can see that. Yes, I'm actually going to be talking about MinRes, a business that we've discussed at some length in the past. We've owned this for quite a while. I own it personally. Internally, it comes up an awful lot, mostly from me. It's a business I've learned to love over many years. And the reason for that is, uniquely in the resources sector, MinRes is a business that breaks every conceivable rule you could find. And that can be construed as a bad thing, but I actually think to do well as an investor, well, to do average as an investor, there are a bunch of rules you need to follow. And we all know what those rules are. Every fund manager sits here and preaches all those rules. A business with cash flow, with high ROE, with a low PE or a high yield. There's all these bunch of metrics that most people are looking for when it comes to their investments, and they are the rules. That's the checklist. Everyone has that checklist, and everyone's ticking it off. And if you do that, you'll probably do okay, and you won't blow up. But if you want to do really well in the markets, the formula is not to follow the rules. The formula is to know when to break them. And MinRes is a wonderful example of a business that has broken every rule and scared off a lot of people. And because it's broken every rule, it's done remarkably well. It listed as it actually began as a $10,000 business on Chris Ellison's credit card, and is today morphed into a $15 billion WA giant. That incorporates one of the finest mining services business in the land. I think it's the second or third largest lithium producer in the world, and is now building one of the largest iron ore businesses in the world. And it all begun with a mining services business. Now, mining services is typically considered to be one of the worst parts of not just the mining industry, but of any industry. I mean, it encapsulates everything that's awful about businesses. It's cyclical, it's capital intensive, and it's competitive. And yet, when Chris Ellison started the mining services business here, it's been the linchpin of the entire MinRes empire. And that's because this is a very unique mining services business. MinRes is built on a crushing business. Now, when you're mining, it's essentially a process of digging dirt out of the ground, crushing it at a particular size, and then processing what you've crushed. The crushing is absolutely crucial. If your crushing processes fail, your entire mining operation grinds to a halt. And so over the previous 20 years or so, MinRes has built up not only an expertise in building crushing plants, all their crushing designs are internal, all their IP is internally generated, but they've also built up a servicing network around WA to make sure if something goes wrong with your crushing plant, within a couple of hours, a part can get anywhere from the distribution center, which they have in Kwinana, to anywhere in WA. So it provides us a level of certainty that competitors find difficult to match. And the IP embedded in that crushing business is remarkable. So MinRes can build a crushing plant for about a third of the price of anyone else, and that plant will have productivity multiples of any other crushing plant in the world. It is a unique business, and it's more like an infrastructure business than it is a cyclical competitive mining business. They have a lot of pricing power because this is a small input into a large mining operation. They have contracts that generally last over decades, not years, and they typically last for the entire length of the mine. And there's plenty of volume growth as well. So no matter what happens to commodity prices, if you're producing, you're crushing. And so they're not exposed to the cyclicality of typical services businesses, because the volumes don't rise and fall with prices so much. They collect quite steady, reliable cash flows. Now, they've used those reliable cash flows to start investing in mines themselves. They've bought a couple of lithium mines, which I think that now the business is probably best known as a lithium miner. And their lithium assets are pretty good, and they're going to get better as they develop and really dig into the meaty part of the ore. But the part of the business I'm thinking that probably gets most underrated is the burgeoning iron ore business. And that's because for a long time, MinRes was a bad iron ore business. It bought the collapsed Atlas Iron business sort of years and years ago. And this was a high cost, low volume, low returning iron ore business. Chris Ellison himself referred to it as a shitty little iron ore business. And that's exactly what it was. And so the market has this image of MinRes as a mining services business, which no one thinks is as good as it is, and a lousy iron ore business. Now, they've actually transformed that iron ore business. They invested billions of dollars. They spent 5-6 years building up an entire new province of iron ore and putting infrastructure in there that not only releases a whole bunch of high quality ore at much higher volume rates to generate much higher rates of return, but it also means that infrastructure they built to service their own mines can be used by other people. So once again, Ellison has built a little infrastructure business inside a larger mining business. And those assets will last for decades. I think 50-60 years we can expect the infrastructure built to continue to generate cash flow. Now, the iron ore business goes from sort of a $90, $100 cost per ton down to $40 cost per ton, and volumes double in the first instance, and they'll probably go up even higher after that. So there is a huge growth engine in iron ore alone. And beyond that, the lithium business is in the dumps at the moment. The spodumene concentrate prices have collapsed as I think we were sort of saying that they were bound to do. There was a bubble in lithium, and it is now popped. This is the time, after post the bubble collapsing, that is the time to be interested in a lithium miner. And this is certainly one of the world's largest lithium miners. They're actually building, they have a very specific plan for their lithium assets. And I think it's really interesting. And beyond that, I mean, no one really expects them to do anything else. If all they did was just hang on to lithium and continue to mine, grow their mining services revenues, their volumes rather, at 20%, which they have done over the last 20 years, and then capture the value of this new iron ore assets, I think the share price, that alone would probably double the share price. But they've also discovered one of the best oil and gas finds onshore Australia in the last 30 years. And I think this comes to the heart of what MinRes really is. At some level, this is just an extremely lucky operation. And I think it's Napoleon who said he'd rather have a lucky general than a competent one. And I think in Chris Ellison, we have one lucky MD. He is extremely competent. This first came to my attention actually because MinRes uniquely was the only mining business I could find that focused on returns on capital. Now that's become a lot more prevalent in the industry, but this business has a laser-like focus on returns on capital. That's the guiding principle. That's what incentives are paid on. That's what every capital allocation decision is based on. But on top of that, you've just got this layer of luck. I mean, the bloke had the world's second largest lithium mine gifted to him for $7 million out of bankruptcy. He drilled a random hole in the ground in WA and found one of the largest onshore deposits ever found in Australia. And I think there's every chance that thing is worth sort of $20, $30, $40 a share. So there's enormous upside in MinRes, and a lot of it is going unrealized because there is a perception about MinRes. There is a story here that this is a low quality mining services business attached to a crappy iron ore business attached to a bombed out lithium business. None of those stories is true. In fact, quite the opposite is true. We've got one of the great mining services businesses in Australia inside this company. We've got an iron ore business that's now world class, and that will lead to profits going up multiple times. And we've got a top 3 lithium producer in the world with high quality assets with an admittedly bombed out price. But you buy these companies when the price is bombed out. We don't buy them during the boom. So this is the perfect time to buy MinRes. The market is wrong on it. They're starting to turn around. The share price has gone up a little bit, but it's gone nowhere for 2 years. The iron ore project, they announced just the other day, it is now running operationally. This would be the only new project in WA over the last 5 or 6 years that is on time and on budget. No one else is able to deliver a project that has come anywhere near on time, on budget. This is a remarkable business, and I'm quite excited to own it.
I was just going to say
Gaurav,
there,
can you just quickly talk about why Pilbara?
Sorry, go ahead.
Sorry, Tom. I was just going to say, Gaurav, can you just explain why we own Mineral Resources and Pilbara, which are 2 of the most shorted stocks on the market, or at least Pilbara is anyway.
Yes, that's right. So we do own Pilbara as well, and Pilbara is, they're both probably shorted for the same reason, is that there's still a lot of negativity around the lithium market. There was a couple of years ago this enormous enthusiasm about lithium and about the EV market in general, and that's completely flipped. I mean, you listen to the narrative now, and it's all about how EVs are awful, and the growth rate has slowed, and the lot of negativity is now seeped into that market, and so people are looking for ways to short the EV lithium theme. Pilbara is the largest, most liquid lithium miner in the world, and it's the best vehicle for shorting, and that's why it's 20% of the stock is short sold. But it also has probably it's probably the best lithium mine in the world. I mean, there's one lithium mine that's geologically better, but it's run awfully with terrible incentives, and this is Pilbara. Not only has a wonderful geological endowment. They have a fantastic management, billions of dollars in net cash, really sensible growth options. In 60 years, they'll be mining lithium at a lower cost than anyone else. Very happy to own that business. MinRes they're carrying debt, quite a bit of debt, and there has been concerns that that debt will need high iron ore prices and high lithium prices to support it, and without high commodity prices, that a dilutive capital raising might be required, or a fire sale of assets might be required. And I just don't think that's the case. I mean, I followed Chris Ellison for a long time. You only need to spend a little bit of time listening to the bloke talk to realize that he is completely on top of his balance sheet. And there are so many assets inside MinRes. There are so much optionality to raise money and to reduce debt. And I think one of those options is going to be realized. They're going to sell a part of the infrastructure that they built. And I'm not concerned about that debt at all. So I think the reasons that those two stocks are short sold don't really stack up.
There's also a step change in profitability coming from this business. So the 49% sale of the Onslow Iron Ore haul road should at least keep the short-term issues at bay. The analysts have been given a hell of a time, which I sort of find, obviously as analysts, we need to be critical of all these things and make sure we're on top of things. But here's all these analysts giving this guy who started this $15 billion or $18 billion in enterprise value business from scratch, who knows this business inside out. And here's all these guys, sitting in their offices telling him he needs to reduce debt, just as about the earnings are about to take a giant step change. And I encourage anyone, if anyone's actually prepared to dig into the detail of a company, and this is a beast of a company, don't get me wrong, there's 4 different divisions. It's a lot, and it's not sort of typical, easily understood industries or divisions. But just go and have a look at the presentation slides and try and have a listen to 1 or 2 of Chris Ellison's recent speeches, and which ties it all together. And this company has an embarrassment of riches. Gaurav talked about how lucky he's been, but he's just also taken his luck and been really smart. Always owns the assets and the infrastructure, always gets partners on board to pay for all these things. It's quite incredible. And I've been a bit slow to this story of just how good it is. But this is a company that's also just undervalued at the moment because people are so focused on lithium and the balance sheet. And yet, if you have a look at the analyst numbers, in 2026, the EBITDA numbers are expected to almost double. And it puts this business on an EV to EBITDA multiple of around 6, but this is more of an infrastructure business than it is a cyclical mining business, and that's where the discrepancy lies, and that's why we expect to make plenty of money out of this business. But if you just have a look at that mining services business, and that's why I led with the slide just before about, is this the best, most underappreciated business on the ASX? And I think it is. The returns on capital are enormous, and it's locked in for the next, I think the average age is 5 decades or 70 years for some of them. It's just absolutely incredible. So the growth is coming regardless. It's locked in, and it doesn't rely on commodity prices. It just relies on the volumes. So that's why we own this instead of BHP, for example. Tom, did you have any questions?
There's a lot of questions coming through about Min Resources, talking about even Chris is 67. Is there? Obviously he's the key player and everything, but is there succession in the company? What's that looking like?
Yeah, so Chris is he's promised at least another 10 years as CEO and chair. Beyond that, the rest of the team is fantastic. This is it reminds me a little bit of Wesfarmers now. It's just a collection of really high quality mining executives. And when they do leave and go elsewhere, it's worthwhile noting when a MinRes executive goes somewhere else, they typically do very good things. There is something about this culture here that's developed really good management expertise. I'm pretty confident in the rest of the management here, but there's no doubt that Chris Ellison runs the show, and it will be that way for the next decade.
That's always the case, though, right? With all the companies we buy, we're trying to back these great managers, and they can't easily be replaced. Sometimes there is great succession. Whether Greg Abel at Berkshire Hathaway can be a great replacement for Warren Buffett, I'm not sure. He seems to be incredible so far, but it's going to be different one way or the other. But he's also doesn't need to grow the business as fast as Buffett grew at all those, particularly in those earlier years. He doesn't need to pull off, huge wins just to keep things ticking along. So Tim Cook at Apple, we didn't need to be Steve Jobs to keep the business rolling along. We just needed to make a series of intelligent long-term decisions. So, but the way you diversify this is through a diversified portfolio, right? We back 20 or 25 managers, and occasionally managers are going to get replaced, or they die, or they move on to other jobs, or they just get old, or whatever. So that's why you have a diversified portfolio. But as Chris Ellison said recently, he said the business has never been in a better position. And when you've got a business there, we've locked in business for 5-7 decades. All you need is, Warren Buffett's ham sandwich to run the business. Like it's a less complex business in that sense than what it used to be, because I used to have to try really hard to find staff, try and hang on to staff, and now people actually want to work for Mineral Resources. So as you get bigger, a lot of other things actually become easier. Gaurav, can you just quickly run us through RPM Global, which has been our biggest holding up till recently?
Yeah, RPM Global, many subscribers would be aware of this. We've covered this stock for a long time, owned it for a long time. Once again, I own it personally. I know plenty of the team own it as well. I think that headline is quite accurate.
I should say I own both of these stocks as well, Gaurav. And
yeah, good.
Sorry, Gaurav, to speak over you. I was just going to say I own them as well, so I should point that out. And basically, my portfolio is the Gaurav Sodhi portfolio.
That's probably the kiss of death right there. RPM, that earlier slide is probably an accurate statement. This may be, and it's gone up. I think we've made 4 or 5 times our money on it. Probably more than that. But it's a multi-bagger, and it's still probably one of the cheapest cheapest software stocks on the market. Now, we first bought this, as many people will be aware, because it was a consultancy business turning into a software business. And there was a CEO, Richard Matthews, who came on board, took a stake of the equity, and he had a track record of building and selling software businesses. He had done Mincom, which was a pretty well-known mining software business, has built that and sold it. There was another one he had built and sold, and he came here. RPM was mostly a advisory consulting business, and they had a little tiny software arm. And during the teeth of the mining downturn, Matthews went out and built and bought hundreds of millions of dollars worth of fantastic mining software. He built some of it and he bought some of it. I think in the last decade, they've spent more than $200 million just building a suite of high quality software for the mining industry, bespoke to that industry. And some of it is software that no one else has. And I think so. 2 things have happened here. The first is that the business has just been transformed. And the consulting arm is now a much smaller part. I mean, it's still there. It's a small part of the business. 80% of the business is now, probably more than 80%, but it's now a mining software business. And the software has gone from being sold at one-off packages to now being sold as a subscription service. So they get these nice, reliable revenue streams. During the transition of that, you lose a lot of money up front, but then you gain longevity and reliability over time. And it's taken a long time for them to get to a stage where they've got the customer base now where the subscriptions more than offset the losses from the upfront sales. They've actually pre-sold about $140 worth of software that hasn't even been recognized on the books. So if the business stopped growing tomorrow, you'd still see over the next couple of years an additional $140 million. And I think they'll probably make a 40 or 50% net margin on that. So there's heaps of money coming in the door, even if they just stop growing, just because of the way the accounting treatment works. And the great thing about this business, and the reason it's still such a large position in the funds, is that they aren't stop growing. They actually, the growth is accelerating. There's a couple of products here that have now become industry standard. AMT is a scheduling software that is now the standard in the industry. It's what everyone gets trained on. It's what most big miners use, and that's going to be earning them revenue for decades. Extremely high margin, Anyone who's not using it now is probably going to switch over to using it because that's what everyone gets trained on. There's another software module they have called Execute. The same thing is happening with that. That's now becoming industry standard, and everyone's getting trained on it. All the miners are switching over to it. And again, that's going to be another piece of software that gets embedded into most big miners. They are the only business that integrates operational and financial software. So if you're BHP running the mine pit, you got whatever happens on the mine floor gets relayed straight back into the financials. No one else in the world can do that. This is a unique suite of software built over time, carefully assembled, and the cash flows are now only starting to make themselves present. So we've got this great operational story that hasn't really translated into the financials, but now over the last 6 months or so, you're starting to see the financials kick along. And I think you'll see that happen more powerfully over the next couple of years. All the additional revenue is now going to drop straight to the bottom line. Free cash flow yields are going to rise. And this is starting to become a bit of a cash maker. It's taken a long time for that transition, but it is happening. The market's aware of it. The share price has gone up a little bit, but I still think there's an opportunity here because the cash generation quality of the software is fantastic. So we're quite happy to hold this for a longer.
I've been thinking a lot lately, just because of the huge impact that ETFs are having on the market now. And you're seeing these just huge moves in stocks at times that are far more pronounced than I think what we've seen in the past, particularly around big news items. But I've been trying to think of how we can take advantage of that. And the only real way is just an old way anyway, and that is to find these companies before they get included in major indexes. Yeah. And what we saw with Ordinate is that eventually people started cottoning on. Obviously it's sort of in the tech / sort of AI sites of people. So it happened to be in the right place at the right time. And we saw that stock just absolutely take off. I think if you look back in the reports not long ago, I was telling people it's going to take a while for the company to grow in its earnings into the share price. And then it just like doubled again. And then it's come back a little bit recently, but we've already taken a lot of our profits. So, but RPM Global is halfway through that at the moment. It's around a $550 million market cap at the moment, which just probably qualifies it for inclusion in the small cap index. Then the next index announcements are about a week and a half away. I don't know whether we'll get included or not, but you can already see other fund managers buying the stock. You've seen the volumes go up. You've seen the share price go up about 60% in the last 12 months, and you're just seeing it written about more often. So, personally, I think this is the company that gets taken over at some point. Most great or good small cap stocks get taken over anyway, but I think this is one that's more likely than others. But I think my guess is that the price will be closer to $4 before that happens. But this is also one that's I think MinRes eventually can be included in the top 20 stocks in Australia if all works out. Yeah. And I think RPM Global, if it doesn't get included in the small cap index in week after next, then it's certainly coming. So it's really nice to see everything going in the same direction. And this is really the sweet spot. You spend all these years trying to find these stocks, and you sit there frustrated that the market's not seeing what you're seeing, and you're waiting for the big increase in the share price, and finally it starts coming, and you start seeing everyone else writing about it. It's getting more notoriety, and it's getting included in more funds, and we're halfway through that process for RPM Global. And so then what happens for our fund is, because we can't own many of these stocks, and actually that's the reason why we've got such a large cash amount at the moment, is because we need that. Otherwise we can't hold a small cap like RPM Global. But what happens is they get to a certain market cap, and then they're no longer falling into our liquidity buckets. And so then they become the next mid caps, and then we go and make that leaves room for the next small caps that will hopefully become the next group of mid caps. And that really explains the evolution of our funds, and that's how we manage them. We'll leave that one there because we're running out of time. Tom, have you got any questions, whether they be specific about the companies or just generally about the fund and how it operates?
Yeah, there are a lot of questions, and obviously there's ones that we received when people signed up for the webinar, which is fantastic. I guess if we're moving to more of the funds in general, so we've got 4 funds at Intelligent Investor, and we get a lot of questions about the crossover between all of them, and if the Equity Growth Fund has much crossover with the other funds.
Yep. So the way I think about our 4 funds is the select fund's a little bit different because that's an international fund, but the 3 Aussie funds, basically I start from the premise that if I had my way, I would have all those 3 funds exactly the same. They would be very cheap stocks, very high growth, big dividend yields, great balance sheets, and they'd all pass the ESG filters. So that's my starting point. And then after that, you start to make compromises. So obviously with the income fund, you've got to get the yield up. So that's why I always keep BHP in there, is keeps the yield up. And if you get those iron ore calls wrong, you're on the wrong side of those, can be really painful, as anyone invested our income fund in 2019 will remember. And then the ethical fund, obviously the ESG filters. So we've got companies like New Hope Coal in the growth fund, which obviously can't go in the ethical fund. But hopefully, with the result, what we want is there are only so many great ideas on the market at any one time, and we want those great ideas to be, the biggest positions in all the funds. So there is overlap. The biggest overlap is probably the growth and the ethical fund. But obviously, the growth fund has stopped a little out of coal. So well done to Gaurav. Investors should be thinking for that a couple of years ago, and that just didn't happen in the ethical. But it hasn't held back the ethical. I've always thought when we launched ethical, it's going to be really interesting to see over a long period of time whether the ethical fund does better than the growth fund. And they've really, I think they've acted quite differently. So that's actually quite interesting. But the same thing, it's always the same thing for me is, yes, there might be overlap, but I actually want overlap, but obviously the funds are very different. That said, it depends what you want from the funds. Do you want the ethical filter? Do you want income more than growth? Do you want the international to diversify a bit more? All those sort of things. So I do want overlap, but they are very different funds. But at the end of the day, all I want is all the funds to outperform by at least 2% and preferably at 3%. And we've done that. So I'm really happy with that.
Would you like me to just move on to, I guess, the business end of the talking about the admin of the fund and this actual offer itself?
Sure.
Yeah, sure. I think there's your favorite slide that I think features in every webinar we do from Chris Cuff. But basically,
people should realize that a lot of these slides are more for me than they are anyone else.
And me too. But basically, there's a list here just of some of the features of the ETF, so the exchange traded funds, and it trades on the ASX under the code IIGF. So you can buy it just like a share. You buy a unit of it, and it trades at the net asset value. So the buy and sell is either side. Highly liquid. We always get these questions, so we're sort of preempting them. Obviously, focusing on the high quality businesses, long-term holdings will help minimize tax. There's the semi-annual distributions and regular reporting and candid communication. So I've definitely seen a lot of those updates that Nathan and his team provides. The management fee is 0.97% per annum. So that this one does not have a performance fee. It's just 0.97% per annum. So the actual offer, what happens is we make an offer once a year, and we say that you can buy it directly through us at Intelligent Investor. And a lot of people say, well, what's the benefit? Well, it means that you can actually transact directly with us and avoid paying brokerage, and you don't actually pay the spread. There's no buy or sell. It's literally given to you at the net asset value, which is determined on the closing date, which is the 31st of May, a Friday at 5 p.m. So we take the net asset value at the close, and we give that to people who subscribe in this offer. And there's a QR code there too. So if you are watching this on YouTube at a later date, you can simply snap it, get taken straight to the application process. But it will close at 5 p.m. Sydney, Melbourne time. So for everyone in WA, and I know there is some, thank you for waking up early for this, and it closes at 5 p.m. Sydney, Melbourne time. So if you are going to apply, don't wait the last second. Some banks actually make you break up your payments, so it's best to do it as soon as possible. We then allot on the 6th of June, and the listing date is the 7th of June. So the minimum investment amount's $2,000. And if you make an application and you say 2,000 and you think I want to send some more, that's no problems. Just go ahead and you can send more than that, and we'll do all the calculations back end. The benefits are already there, of course. The fund does pay dividends, and they will be franked. There's the semi-annual ones, as I mentioned. And this is a very important part here too about providing a holder identification number, so a HIN. So if you have a share trading account, you can give us your HIN number and the account designation, the name that the account is in at the broker, and also the address. So these have to be identical. The share registry doesn't like it if even one little word is out of place. So if you're applying, definitely give us that. If you're already invested in one of our other funds, so 4 in total, we should be able to use that HIN and put it straight to your share broking account. If not, it'll stay at the registry and then you can transfer for free to your share broker. So it's very important to make sure that the details are correct. You can email a copy of your CHESS statement so that we can see exactly if you like, and that way we can help you and make sure that the transfer is seamless. And lastly is, how do I apply? Straight through the website, intelligentinvestor.com.au/IIGF-offer. The QR code is there. There's a banner on the website too. Are you ready to take some questions? I've got a couple up my sleeve here.
Yeah, I'll just mention one thing on the liquidity, Tom, and a lot of people look at the daily trading of these ETFs, and sometimes there might not even be any trading, and people automatically assume that the funds are illiquid, and that's not the case. The way ETFs work is the trading is just the demand or lack of for the fund on that particular day. It has nothing to do with the liquidity of the fund. The average market cap of the stocks in the fund is over $16 billion, so it is an extremely liquid fund. We have all our market makers behind the scenes doing all that, so you'll always be able to sell your units immediately if you need to. Don't imply that low amount of trading for the fund on the ASX means the fund's illiquid. And believe me, all the grief, the biggest challenge with our funds is the liquidity constraints from the ASX and also from our own investment committee and the board, who that's all they really care about. When I have to go to the investment committee meetings, is that no one in Australia in these management positions wants anything to do with an illiquid fund. So you don't have to worry about liquidity.
Okay, I'll just go through and have a look. This is a very good question too from Brian. How much do the II guys have personally invested in these funds? I know that InvestSmart Group, which is the parent company of Intelligent Investor and InvestSmart Funds, there's a lot of us on staff that are invested in the ETFs as well. But a lot of you already invested in some of the stocks you recommend also. Is that right, Gaurav and Nathan?
It's not just some of the stocks. 90% of my portfolio, 90% would be stocks that I recommend. There's a spattering of small stuff that we don't recommend, but all my big stocks, my 3 biggest holdings, Lovisa, Minres, RPM Global, there's plenty of money there, So I'm eating the same thing you're eating.
I'm not going to admit how much money I've got invested in those 2 stocks either. But I own 2 of the funds in my super. I'm obviously not going to say how much, but our analysts are allowed to buy stocks themselves, subject to the staff trading policy, and I think just about everybody in InvestSmart has shares in InvestSmart itself. I actually like the fact that the analysts can buy stocks themselves. I think it has a lot of advantages, and I think one of them is that sometimes an analyst gets frustrated if they can't get their stocks into the funds. For whatever reason, and at least that allows them to go and buy them. And we're also only a small fund manager, which is why we need to grow our funds business. We're not getting paid massive amounts of money like a big fund manager, a Platinum or anything like that. So we need the ability to be able to really, I guess, supersize our bets on the stocks that we like the most, which are in the funds. And I like that. I like us being able to be concentrated in the best ideas. And I think that's what really gets, because we don't pay massive salaries, that's what enables us to get and keep really good analysts, because it's really, really hard to find good analysts, and it's even harder to keep them, especially in this market where most fund managers are doing pretty well in this environment. So we need an outlet for them, and that's really the challenge that I put to them. So we can't match the pay of other companies, and there aren't big bonuses or anything like that. But if you're a good investor and you're prepared to back yourself, then you should be able to make up for that with your own investments. And if a potential analyst says to me that I don't like that or can't do it, then they are absolutely the wrong analyst for us.
I think speaking about challenges here as well, this is constantly a challenge for all of you, is what businesses are you watching closely with the aim of buying when the price is right? I think numerous webinars we've spoken in, that's usually one of the biggest challenges, isn't it? Actually finding companies that fit all the criteria from a value investing perspective, but also the criteria that you have in terms of who's running the business. Do they have skin in the game as well?
I don't know if Gaurav wants to give one away that he's looking at, and
Yeah, I
or
won't give
may
it away.
just keep that
I won't give it
ourselves
away
for the
yet.
moment.
Yeah,
There's one
there's
coming.
one I'm looking at. Yeah,
But
there's one.
one-
It's sorry, go. You talk, Nate. I'll sit quiet for a second.
yeah, no, I'll get you off the hook. One I think is interesting for anyone who was following the market yesterday. There were two big announcements for companies that we follow, and one we do own, and one that we don't own currently. So, and that was Sonic Healthcare and James Hardie Industries. And James Hardie worked out brilliantly for us. And I sold, I think, all of our stocks at above $60, which turned out to be prescient because yesterday they had a more somber outlook, and the share price, I think, fell about 15 or nearly 20%. And it's probably not surprising. Obviously, higher interest rates are having some impact on their volumes, but also just most companies are having trouble keeping their costs down in this highly inflationary environment, and particularly when you've got labour shortages. When companies like Sonic, which need specialist staff, they're having to pay these people more, so their profit margins are getting scared. Basically, the exact almost the exact same issues as James Hardie. Was that their costs were much higher? They actually had really good revenue growth. So we already own Sonic, so there wasn't much to do with that one. But James Hardie now is, now the share price has fallen 15 or 20%. That's squarely back in our sights.
I'll throw in Pinnacle in there. That's one I'm got that on my watch list. I'd love to own. I own a little bit of it, but not enough. I'd love to own more of that stock. But it's probably fairly priced. I like to buy that a little bit cheaper. But that business has a very clear growth path. They're just continuing to do the same thing they've done for the last 10 years. Wonderful management, clear articulated strategy, and excellent economics.
Exceptionally well managed, that business.
There was a question here. We'll probably get to the end of this, and we've got so many questions that have come through about various different individual stocks, but I might even forward it to both of you and see if you want to put something together after. But Ordinate is featured pretty heavily in our presentation here. Do you have any comments on their video business that they're developing at the moment?
I'm the analyst on Ordinate, so I guess that one falls to me. Look, I've owned that since we first recommended it. Never sold a share. My intention, I guess one of the benefits of running a little personal fund is that you don't need to max. Every year you don't have to maximize your return every year. I'm quite happy just to sit there owning Ordinate. I know this is going to be a multi-billion-dollar business in my view, and quite happy to sit there and wait for that to unfold. I mean, look, it's always crazy. The valuation a couple of months ago was ridiculous. It's still ridiculous. It still looks crazy. But if the longer your outlook, the more comfortable you should be to buy. If your outlook is short, this is not a sensible purchase. But if your outlook is long, then it can still make sense to buy today.
Excellent. Well, look, we'll leave it there. And what we'll do is we'll get a recording of the webinar put up onto the website. We'll email everyone. We'll put the slides up there as well, because there are a few companies that we have some slides about at the very end of the presentation. And remember that the offer, the website there is on the screen, and it closes the 31st of May, Friday, 5 p.m. Australian Eastern Standard Time, Sydney Melbourne time. And if you're interested, definitely read the PDS, do your research. Feel free to call us. You can ask questions as well. I'll just put the phone number back up here in case you would like to do that. I'll just hide that. So yeah, you can call us or just email invest@intelligentinvestor.com.au. And on the website as well, there's actually the live chat, which is Monday to Friday, 9 a.m. to 5 p.m. Nathan and Gaurav, thank you so much for joining us and giving us all of that information, that insight, and thanks for your time.
Thanks, Tom. And thanks, Nathan, for the invite.
Thanks very much, Tom. Thanks, Gaurav, and thanks everyone for listening in.
Thanks, everyone. We'll see you next time. Bye.